Everyone with a mortgage, both homeowners and property investors, are keen to know when the next interest rate fall is going to come. And last week's CPI figures gave some people confidence. But is that false confidence? Is the Reserve Bank going to drop interest rates again soon or not? Well, in today's Property Insider chat, Dr. Andrew Wilson is going to give you his thoughts, and you probably won't be surprised that they're contrary to what a lot of the media is saying. So if you want to know what's ahead for our economy, we're going to explain that in just a moment. But if you want to keep up to date on a regular basis with what's happening to our economy and our housing markets, just subscribe to this YouTube channel and please click the little bell icon so we can keep you updated each time a new show comes out. Now that the Reserve Bank has delivered its first rate cut for this cycle, everyone's keen to know when the next cut's coming and carefully watching our inflation figures. Well, last week, the Australian Bureau of Statistics reported that the monthly CPI for January rose 2.5% on a year-to-year basis. So 2.5%, does that mean inflation's under control and we'll be getting further rate cuts? Or maybe it doesn't. That's what I want to ask Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hello, Andrew.
Yeah, good day, Michael. And it's important that we do focus on the inflation data as it comes through. We had the latest data out last week from the ABS, and that's the monthly inflation data, and that was for January. We must point out that the Reserve Bank has stated that it looks at the quarterly inflation data, and particularly the underlying measure of inflation in that quarterly data set. It's a bit questionable, really, Michael, because we're really the only advanced economy that uses quarterly inflation data in terms of its monetary policy settings. Other advanced economies, US, UK, Europe, they use the monthly data set. And even though we've been using the monthly data set under pressure, the ABS moved to provide a monthly data set a couple of years ago, it's still not regarded as being, the real insight into inflation. So, there are a number of issues here. Of course, it's that, we're measuring inflation, or we're looking at inflation on a quarterly data set to set our interest rates. And,
which is very far in behind us already, isn't it?
Yeah, 100%, Michael. Of course, this is the problem. And yet, and that means that there's even more potential to make mistakes in terms of, what the Reserve Bank is, revealing, in its opinion, what inflation is. And but we need to look at that monthly data set. It's important, and we look at it every month to give us a forward indication. As I've said here before, now, the Reserve Bank's taken a real punt here in terms of the outlook for inflation. The data really hasn't supported essentially what the Reserve Bank has been telling us, what their feelings are in regard to, easing interest rates, particularly given the word that it uses now, and that's sustainable. We've certainly had a sharp fall in inflation over the past a year or so, and that was really not a surprise given the inflation exploded during the COVID stimulus period, because we just created so much demand and we still had the supply roadblocks of COVID. Now that had started to ease, particularly in relation to the price of oil, Michael, which is an important driver of inflation. But now we've got sort of other factors that have come along that really add to the question mark about, is this sustainable? And I'm not sure the Reserve Bank can justify its position on inflation in terms of sustainability. Yes, certainly the trend has been falling towards the Reserve Bank's target range. Of course, that target range is between 2 and 3%, ideally 2.5%. But it's consistently told us that it needs to be sustainable. And yet the factors that have pushed inflation down are anything but sustainable. And that's why we're looking at these monthly figures just to see if they are being sustained, right? Now, the January data, what came in, the annual growth rate came in, as you mentioned, at 2.5%, which is the same as the December result. Now, that's right in the middle of the target range, so that's good news in that sense. But as I said before, The Reserve Bank looks at the quarterly data set, and it looks at the underlying measure of inflation. And when we look at the underlying measure of inflation for the month of January, it actually increased, Michael, from 2.7% to 2.8%. So it's actually heading in the wrong direction, Michael, at the moment. And as I said, the Reserve Bank is always going to say, well, it was just a 0.25% cut, and it's some sort of a benefit for those that have been sort of doing it hard, whatever, during the high inflation period. But nonetheless, it does question this sense of sustainability, because if this data moves the wrong way, there's going to be some very serious question marks over the competence of the Reserve Bank again, which we've sort of had over a couple of years now. But when we look at the results for the headline inflation data, it does reflect that issue of sustainability, because we're seeing now the big jump or the big decline in inflation that came from the government's electricity handout. Of course, as we remember, in the budget last year, the government gave, quite welcome, of course, $300 to all households for relief of their electricity bill. And electricity has been rising because of the shift out of the carbon economy, into this, this future of renewables. And that has, in the shorter term at least, pushed up electricity prices quite steeply. And that's the reason behind the handout from the government, and also to impact inflation, which it's done. But Michael, we're now starting to see that in that handout, the electricity bill handout, losing its impact on inflation. In fact, over December, the month of December, the price of electricity actually fell by 17.9%. But that was down from the 21% of the previous month, and down again from the month before that, which was over 30%. And the fall over the year to January was 11.5%. So this is sort of reinforcing, Michael, my view of sustainability. We clearly don't have a sustainable reduction in electricity prices, which is a big part of the inflation number, because that's now starting to wane. Now, what can the government do? Does it give us another handout? So in other words, this isn't sustainable because it's a handout from the government to ease the high costs of electricity. And we're now starting to see that this isn't sustainable because the annual impact is starting to decline, and has been declining for a number of months. When we also see the impact of fuel prices was also higher compared to the previous month. So the previous month, fuel prices were up by 1.4% over the year, and they increased to 1.9%, Michael, over the year to January. So again, this beggars the question, is this sustainable? And this January data is telling us the answer to that is no. And, the Reserve Bank has certainly, taken a stake that the data would be sustainable going forward. And with the January data is telling us that sustainability is certainly looking a little bit so-so. We had an improvement, however, in rents. We know that the steep increases in rents that we've experienced over the last couple of years have eased. And that's not a surprise, given that, the rate of growth couldn't have been sustained just on income growth alone, Michael, for rents. And that we've also seen a reduction in migration numbers, which has also taken pressure off the rental market. But still, from an annual rise of 6.2% over December, so rents increased by 6.2% over the year to December. That's fallen back to 5.8%, Michael, over January. Now, I say, well, that's good. We're seeing that trend continue, but this is still above that rental growth. That annual rental growth is still above historical levels, Michael. So it's still quite high. And as we'll see shortly, that relief that we've had from high rental increases, or tenants have had that relief, is now looking a little soft going forward, with underlying measures showing perhaps a bounce back in rental growth. And the other point is that The rents that the ABS measure reflect total rents in the marketplace, whereas what we measure, of course, are asking rents. So they're the rents of properties that are up for a lease at the moment, rather than leases being renewed in general. So it takes some time, Michael, for what's happening in the real-time rental market in terms of vacant properties and asking rents to convert their way back into the total rental market. So we've still got some way to go to see whether that's going to be sustained. I know this has been a lengthy, interpretation of the data, but I think it's very, very important when we're talking about the prospect for interest rates going forward. And of course, this is the first month of the quarter, Michael. We have 2 months to go, so anything can happen. And that again emphasises my point about sustainability. That we're looking into the future, and as I said, anything can happen. So it's been really questionable, the Reserve Bank speaking about sustainability in an environment of quite severe uncertainty when we look at the data that has been moving inflation downwards. Now, the headline or the underlying inflation rate, as I said, is still between 2 and 3% on the monthly basis, but Michael, it's moving upwards. And that wouldn't be good news, certainly over the first month of the quarter, for the Reserve Bank.
Well, it'll be interesting to see in an election year what other things come out of the woodwork to give us incentives and maybe lower inflation again. So oil prices have also been a major factor in
Yes.
inflation. You mentioned that on a regular basis. Oil prices, international oil prices, and they've been slipping lately. They've been coming down.
Yeah, well, they have come down, Michael. In fact, they've come down, and when we measure the inflation rate versus the oil price, it sort of really tracks it quite markedly. So it's important to look at what's happening with the price of oil to give us a sense of the outlook for inflation. The price of oil certainly has eased from its peak back, in the COVID period. But it's just started to level out now. We can look at the price of oil over February, of course, because February is behind us, and the price of oil has fallen over February compared to January. But the point is, we have a lot of I guess potential global disruptions happening at the moment. What's going to happen with tariffs? The geopolitical outlook with Ukraine is certainly highly problematic at the moment. And how these things play out on an ultra-sensitive commodity such as oil is yet to be seen. But certainly, when we look at the track of oil in the shorter term, the February data is promising because it's now tracking 7.3% lower than where it was a year ago, Michael. So that's good news when we do equate what's happening with oil to what's happening with the inflation rate, because inflation over February oil prices are actually 7.3% over a year ago. So I guess what we can say is when we eventually get that February inflation data coming through, that'll be a big improvement for oil prices, and that will work its way into inflation, which will make the Reserve Bank feel a lot better, if you know what I mean, Michael.
Yes.
So we can sort of say that the latest data, and that's what we do here. We're trying to look at the latest data, not the backward data, to give our listeners and our viewers some credible insights into the prospects for the market and inflation and, of course, interest rates. So good news there for oil over the month of February, and good news going forward to its prospect for a better inflation rate over February. But of course, we are looking at the trimmed mean, Michael. That's the preferred measure of underlying inflation, and that might take out the price of oil because it does remove the volatile elements. So it might not be important. But I do think at the end of the day, lower oil prices generally, regardless of the measure the Reserve Bank uses, is good news for inflation because that works its way through the economy.
Well, at the end of last year, rental growth slowed after a couple of years of very strong rental growth, Andrew. But now historically low vacancy rates and continuing strong demand seem to be pushing up rents around the country again.
Yeah, we have a measure at My Housing Market, Michael, just to sort of tune in with what's happening with inflation. We have an underlying, I guess you'd call it, rental index. This measures rents from quarter to quarter. So we're taking every week. We're taking the 3 months to the end of the week, right? And then we advance it month by month. So that gives us a feeling how that's advancing on a weekly basis. And when we look at that index, Michael, and we've indexed it starting at 2020 at 100, you can see there that there has been an improvement over the back end of 2024. We know that. We know vacancy rates have increased. We know growth rates have eased. And we can see that on the index occurring over the latter part of 2024. We know that a number of measures are confirming it. But what we're seeing now when we look at this underlying index, which is picking up what's happening on a weekly basis, Michael, we're just starting to see a kick up in rents again. So not so good news here for the Reserve Bank. We already saw that rents are just still rising by just under 6% a year by the ABS measures, which is, still historically significant increases. But our index is showing maybe just some early signs of a rebound in rental growth this year, Michael. And this is annual growth on the quarter by quarter basis. So we'll wait and see what happens. But as I said, what we're doing here is just providing some monthly insights into the prospects for inflation and therefore the prospects for interest rates. And as you mentioned, there's a lot of chat about, are we going to see any more interest rate cuts?
Well, on the ground, the team at Metropole are finding that there's lots of tenants there again and open for inspections, and vacancy rates are low, and properties are being snapped up very quickly. I had one of my properties vacant and it was open for the first time on the weekend, and the property manager sent a report. 13 people inspected this apartment. 13 said they were going to, 13 parties said they were going to apply for it. Now, I know that not 13 won't, but that'll be leased after the first open for inspection. And that's the trend we're seeing in Melbourne, Sydney and Brisbane, where we've got a presence on the ground in the rental market. And of course, if that happens, landlords and property managers are going to feel more comfortable pushing rents up a little bit, aren't they?
Oh, and you heard it here first, Michael, because that index is showing us that there's a rebound. And as if you remember our latest rent report, which was for which was for January, it had actually shown a rebound in the rental market with vacancy rates falling and a stabilisation of rents, and rents in some of the capitals for units were rising again. So I think that's reinforcing that our underlying index, and you're validating that by your own personal experiences. And I would expect to see that trend for tighter vacancy rates. We will be releasing the February rent report next week. We will discuss it next week on the show. So we will be able to see just what's happening with the rental market. But early signs, again, are not good for, the very important measure of inflation that rents are. And I haven't mentioned this today because we'll get the latest data in a couple of days. But our latest data was also showing house building costs starting to show some upward pressure as well. Now we'll get the latest data on that this coming week. So we'll talk about that next week as well with rents. So still maybe some nervous times there with the RBA. Of course, they're happy that everybody's got an interest rate cut because there's smiles everywhere. But the main game is to keep inflation under control. If that's not occurring, then there's going to be some pretty tough questions there. And you've got to remember, to the Reserve Bank, Michael, that interest rates are the sort of the fuel line to the economy. And if you cut them prematurely, it means you haven't got something to go to, or you've got less fuel to go to if you really need it. If the economy does need a bit of a lift, you've actually cut a rate and taken away some of the potential to lift the economy. But hey, it's great to talk about this. That's what we're here for, to provide insights and create a dialogue around exactly what's happening, because, we want to know what's happening with interest rates, because that's going to tell us what's happening in our housing markets.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Another thing that gives us an indication of what's going to happen in our housing market, something we see as a forward indicator, is auction clearance rates.
Yes.
The year started with quite some depth to our auction market.
Yes.
Lots of listings and lots of properties being sold. What happened last weekend, Andrew?
Well, it's another positive week, Michael. As you said, it's been a good start to the year. And although some of the house price data has lagged that, we sort of understand it because a lot of the house price data models that come out are including the sort of the seasonal position of the holiday market in January and December, and doesn't include this latest data that we've seen over February, or doesn't include as much over February, but it is coming through now. That comes from the auction market, the weekly auction markets. So with some, big listing numbers again. We've had a lot of listings coming through the market this year, Michael. We've got to remember a year ago we had record listings in our auction markets, but it's sort of tracking around about at the same level. So sellers are still pretty happy, Michael, to engage the auction market. And as I said, a year ago, we had record numbers of listings. Last year was a market for sellers to engage in, and they did that in spades. And it was a good year for the number of sales as well, because buyer numbers stood up as well. So clearance rates overall was steady, despite another rise in listings. And of course, we have a public holiday in Melbourne next week, Michael. So we did see a sort of a front-end loading of numbers to avoid the distractions of the public holiday. And that we see that every year. It's come around in terms of the comparisons a week later this year. But nonetheless, good results there again. And I think that we're still seeing, solid confidence levels from buyers and sellers in our auction markets. And I think that's reinforcing, the prospect of prices growth, Michael, particularly with that RBA growth. So maybe the interest rate cut has put some sort of a floor under our auction markets. And I think they're still, still quite frothy, if I could use that analogy. So here are the results. 1,291 auctions in Sydney, ahead again of the week before. Clearance rate not too far away from the week before. That's a really good result, Michael. Again, nearly 75% clearance rate in Sydney. Almost the same clearance rate as a year ago, but auction numbers well ahead of where they were a year ago in Sydney. Similar auction numbers in Melbourne, 1,300 auctions. That's, again, a good number of auctions. Clearance rate slightly down on the week before, but from our experience of Melbourne over the last year or so, these are good numbers, and again, higher than the same week last year, Michael, in terms of listings and clearance rates. So some good, shall we continue to say, early positive signs for that Melbourne market from the auction results. A big weekend in Brisbane, more auctions than the week before. Similar clearance rate, but the clearance rates in Brisbane are lower than where they were a year before, because we were in that very strong post-COVID migration market in Brisbane. Adelaide, it picked up clearance rate, higher clearance rate, similar auction numbers, and similar to where the Adelaide market was the year before. Canberra slipped down a little bit in terms of auction numbers and clearance rates, but still tracking around that 60% mark. But it's a little bit of a tease, that Canberra market, Michael, because it keeps telling us that it's about to revive, but it just can't take that extra step to get above the mid-60s in terms of clearance rates. So we'll wait for the outlook there. When we look at the monthly clearance rate data over the past 12 months, you can see there that Sydney's tracking certainly comfortably above where it was for most of the second half of last year, and also very similar to where it started last year, which was, as we reinforced, again, was a strong market environment. Melbourne, the same as where it was a year ago, and certainly well ahead of where it finished the year, certainly well ahead of where it was for most of last year, Michael. So good results there so far for Melbourne. The Brisbane market back to its normal environment in the 40s to 50s, and again, tracking lower than where it was at the beginning of last year, which was a very strong period for that Brisbane market. And as we always say, Brisbane has a very individual attitude towards auction marketing. So they tend to have systemically lower clearance rates. Adelaide still a little bit below where it was a year ago. The Adelaide market is certainly, shall we say, taking a bit of a breather compared to how hot it was over most of last year, but still providing reasonably positive results for sellers there, but not at the red hot, even white hot levels of it was the nation's leading auction market over most of last year. And Canberra, as usual, will it maintain itself above 60% through March? But February was certainly a positive start to the year for the Melbourne market. Of course, if you're looking for the latest auction clearance rates, you can get them on my LinkedIn channel, Doc Andrew Wilson at LinkedIn, every Saturday night around about 6 o'clock, and Michael publishes the full national report with the breakdowns for Melbourne and Sydney and the top 10 sales under the hammer over the week for all the capital city markets. So look out for that on a Sunday. And if you've missed it, there's a QR code in this presentation that can give you a PDF link to that. But look on Michael's sites and you'll find that auction market result. So a busy inflation week, Michael.
Yeah, auction clearance results above 70% suggest property values are likely to rise again. And while Sydney has been floundering a bit, languishing a bit at the end of last year, it looks like maybe it's going to have a little uptick.
Well, as we keep running our sales price data every day, Michael, as we do here, I can tell you that that's starting to merge now, that we're pushing away those seasonal factors of December and January and starting to pick up a lot of those results through February. And they're starting to push the Sydney price back upwards into positive territory. And I would be surprised if we didn't see a positive result for the Sydney market in terms of prices growth when we get our March quarter data in 4 weeks' time, because the portents are very good. And as we know, auction clearance rates are a reliable forward indicator for prices growth. And as you said, absolutely, once you're moving into the mid-70s, we do see prices growth emerging, and there were some good strong results. And in the Sydney market, Michael, it's the higher price regions that are still getting plenty of buyer activity. And that's in fact, we had the Sydney median, Michael, auction price at the weekend exceeded $2 million for the first time ever, the Sydney median, and that's coming about through areas such as the Northern Beaches, the lower north and the eastern suburbs and the inner west, really pushing prices up at the moment. But over $2 million median, Michael, for Sydney for auction sales.
Give a good indication of the sort of properties being sold. We'll be back again next week, and I look forward to getting your rental report when we can get an indication of what's happening there. Thanks, Andrew.
Thanks, Michael.